ready. So get set. So hang on.
Take a little longer and it'll be much more wild and volatile. So people have, kind of have to buckle up, right? And
I was waiting for it.
So buckle up. So sit tight. So strap yourself in.
All right, everyone. Welcome to Gray Rabbit Finance Podcast, where we chase the truth behind the money. I'm here today with James Anderson. He's the Senior Market Analyst. He's an author and also the Head of Research at SD Bullion. James, thank you for joining us today.
Thanks for having me. It's a pleasure being on the show.
Awesome, man. So let's get straight into it. What first sparked your curiosity behind the precious metals markets? And was there a defining moment or revelation that made you start questioning the mainstream financial system?
I guess it goes back to childhood, like being in my my granddaddy's house and farm and going in the closet and finding like the junk silver in the closet, kind of feeling like a pirate. And that kind of explained the seed as to why is that. That's kind of weird. And then later going to college, and the college I went to for business school was Loyola University, New Orleans. And a lot of my professors they would give not just the Keynesian but also the Austrian bend. And so they would give you a few different ideas as to different theories of why the economy is the way it is. And so it wasn't just simply brainwashing of what the government wants you to think about monetary policy. And so that was really helpful in the sense of critically thinking through things. And then after college, I traveled, and once you travel, you start to realize the arbitrage of currency and how ridiculous it is. I mean, same goods and services, depending on where you are in the world, could be highly variant in terms of the actual real value you have to give to get them. So that starts to give you an idea as to, this is all arbitrary. Like these people all arrogantly pretend like they run the world and that it all makes sense. It makes no sense. It makes no sense in terms of some of the arbitrage that happens. And so that really, then Ron Paul, 2007, 2008, that was probably really where I got what they call, where I basically became a little bit more rabid in terms of my views and my thinking. And I started investing in gold and silver around that time as well, and really spending a lot of time in it. And it was so much time where it was like, well, I may as well look for a job in this because I'm so into it. And so I started looking in Southern California. The issue with Southern California is that I would say 95% of the job opportunities in California in precious metals industry are with the crooked boiler room dealers, the worst actors in the industry. It's a non-regulated industry, so you get used car salesman types and 100 person desks of just people boiler room, basically taking advantage of granny and granddaddy and people just using unscrupulous sales tactics to get people to pay twice melt for various coins. It used to be semi-numismatics that they did it with, and Glenn Beck. There was a big scandal in 2011 with that, and then they all switched out, and now they use these fractional gold pieces, whether they're from the Canadian Mint or from sovereign mints. They can still go on IRAs because they have sovereign mint status, so it's like this backdoor move they use. They use the fact that it's made by a sovereign government, and they claim, they basically get exclusive right to a certain design, and then they turn around and take granny and granddaddy for more than half their IRA, right? So it's a troubling situation in that. But the good news was in 2008, I ran into a good quality person, and I started working out of a house with Mike Maloney at goldsilver.com, and worked there for 6, 7 years. And, Mike was really helpful in mentoring me in a lot of ways in this market. And so a lot of the things I learned in this market, especially on the cyclical side, in terms of looking at the big picture and where this bull market ultimately is probably headed, he helped me a lot in that sense. And so that's kind of how I went down this path.
Nice. You mentioned that, you were fond of coins from your grandfather. Do you think that humans instinctively know that precious metals are actually money? Or
I think if you put it in their hands, they've gotten used to Cooper nickel coins, and then all of a sudden they feel the weight of actual genuine precious metals, and they kind of touch them. That really kind of hits something deep inside the genetic code. I think that we do get passed down trauma from past generations, and that will start to kind of unveil the fact that, this was money, and my forefathers used this money, and it starts to kind of bring home things that you really can't even put into words. It's more of a feeling, and the feeling just kind of drives home just in your hand.
Yeah, I agree with that 100%. I just gave my little cousin a buffalo, and we were playing a game, like keeping the balloon up in the living room. And I told him if he beat me, I would give him $1. And I gave him a little silver coin, and just seeing his face light up, I think you can tell that it's sort of instinctual, and it's in our blood, sort of. But that moves me to the next question. If you erase a people's past, you control their future. That's a George Orwell quote. How do you respond to those who believe in the idea of a free market? Do historical events like the 1933-35 U.S. Gold Clause repudiation stand out to you as key turning points where monetary manipulation became institutionalized?
Yeah. So the idea of a free market is it's a glorious idea. It's a nice idea. I think a lot of libertarians live in a world where it's fantasy land, and they like to talk about it all the time. And the truth of the matter is, we've never had a true free market in the history of the human world. What ends up occurring is you get close to a free market, and then it ends up being monopolies, and businessmen always want to create cartels and moats. And that's what they do. And they did that in the late 1800s, early 1900s in the United States. They're doing it now. I mean, if you look in the United States, look at your cell phone carriers. There's like four,
Yeah.
So like your choices and options are limited because of the monopoly state that we live in terms of corporations. And the other side, and the 33-34 thing, was that's one of the greatest sins in terms of the United States. We sacrificed the sanctity of private contract law, where people had gold clauses in business in terms of payments, and basically by nationalizing the gold supply and outlawing people who own more than, I believe it was 3 ounces when it was all said and done, because they devalued it by 70%, $20.67 to 35. After they give people $20.67 who were silly enough to go and follow the edict. By the way, the percentage of people that followed that was 3 out of 10 gold pieces that the U.S. Mint struck throughout the entire history to that point. They got turned in, so about 7 out of 10 stayed outside of it, and nobody went to jail, no one went to prison. So that fear mongering of, there'll be a gold confiscation is clown show. Like anybody who brings that up hasn't done the research, and they're just using it to probably manipulate you into something else. So
that was like 25% of the people turned their gold in, I guess, around that.
It was like 27. I'd have to go look at the video I did on it. If you just simply YouTube search gold confiscation 1933, how much gold was taken, and you'll find my video. It's got like 337,000 views, and just constantly.
Awesome.
Yeah, it was like I spent a good amount of time on it and researching it, and it's not my research. I used someone else's research in terms of the U.S. Mint. They basically did all the studies from when the U.S. Mint started to 1933, and they had literally all the coins. They also had the data and records of how much was turned in after the 33, 34 edicts, how much got melted. So it was pretty thorough. I mean, it's accurate in terms of my claim that about 7 out of 10 gold pieces never came in. So that was a big, that was a huge sin in terms of, we basically said, well, private contracts in the United States aren't sacrosanct. We'll do whatever we have to in order to, make the dollar survive and make the dollar, the currency of the realm. And so they sacrificed private contracts. They repealed the gold clause. That precedent was used in Argentina in 2001, 2002, when they froze and had their little corralito in their banks. A lot of locals had dollar bank accounts, and they said, well, the United States did it in 33, 34. We're going to do it here, and they did it in Argentina as well. So you had dollar for dollar bank account. They said, no, now you have pesos. Oh, by the way, your peso's not 1-to-1 anymore. It's now 3.5-to-1. So you basically got thirded, or worse. Yeah. So, and they used that original sin from 33, 34 as the precedent. The other thing is that, in 34, they came out with, the gold. They basically stated, it says it on the Treasury's account. You have a situation where in 34 they said we can essentially go into any market where if it's for to keeping the dollar sound. So basically in 34 they declared they could manipulate any market anywhere in the universe in order to to move the market where they need to for the dollar in those terms. So they've been doing that pretty much ever since in various ways.
Yeah, sounds good. Thanks for that explanation, James. So usually I like to break this up into 3 parts. So we just covered the past. Now we're going to move on to the present. And I wanted to talk about, so this past March 31st was the official Silver Squeeze 2.0. And shortly before this time, we saw David Bateman, the whale, he was entering the waters. What were your overall thoughts on the Silver Squeeze? And what were your thoughts on David Bateman, who he bought? It was 1.5% of the world's annual silver supply, or 12.69 million ounces of silver.
All right, so it's 400 million roughly in notional silver fiat dollar value. That's a lot. I mean, 400 million for one guy. He's a young guy, and I went through his Twitter history trying to make sure I was going to report that it wasn't a psyop or some fake. And it turned out, his Twitter history looked legit, and it looks like somebody who is basically a Silicon Valley bro. Just somebody who's created a business and got it seeded and it's become highly successful. I think he got kicked off the board for kind of a wild tirade email that got turned public, and so more or less he got kicked out of his own company, and now he lives in Puerto Rico. He's probably waiting for the exit, the final exit from his company, which would probably be another windfall. And by living in Puerto Rico, he saves a lot on taxes.
Nice.
But he comes in and out of the chat. He seems legit. And one thing I wanted to make sure, I friended him on LinkedIn, and we all were thinking, if this guy is just like a psyop, he better be deep. And I'm like, let's see if he has LinkedIn. and it works. And I told him, hey man, go accept my LinkedIn, and he did. So And he's been, in terms of his engagement with us, he seems like a real person. I don't see it as being, a psyop at all. And the picture he sent, I looked at it and he tried to block it out, but I could see, it springs Salt Lake City. And that's pretty interesting. And that brings Salt Lake City is not part of the Northeast Comex metro area. I mean, the Northeast Comex, there's like a stipulations. You can't be involved with the Comex warehousing industry unless you're within X miles from New York City.
Okay.
Brings Salt Lake City is totally outside of it. So for someone to be doing that, to be pulling that much, and then also to be taking it outside of the Comex system is pretty. To me, I think it's pretty sound in terms of understanding that you need to be completely outside of the warehousing of Comex in order to actually outright own it and not be an unsecured creditor. And that's what he's done, it looks like. So the one picture he put up, that was only 1/20th of what he bought. And so it's just a vast amount of silver. You're talking about thousands and thousands and thousands of 1,000-ounce bars. So it's a lot. In order to get that even in one picture would be a huge Herculean task. So yeah, that was an interesting thing. And then the Silver Squeeze 2.0 has been good. I mean, the people have been pretty down to earth. There's been no, people who are there just for themselves. Usually that after a month or two, you kind of start to get an idea who's the grifter here, who's going to try and profit off of this, who's going to act out and act a fool. No one's done that thus far. And that's been very nice.
Agree.
The ambiance and the people who've been in the chat. And then, really the ultimate goal of this is just to spread awareness about silver. So we want people to understand, why we're buying it and to give our reasonings and for people to understand that people are buying silver and maybe if they want to consider it, or at least look at what we're doing and then they can decide for themselves. But it's really just a big marketing campaign. And in terms of social media, it's about as cheap as marketing can get because you have a bunch of people working for free who are doing that just because they enjoy silver and they're very creative and they want to share the message. Yeah,
absolutely. And if anyone's interested in reading some of David Bateman's thoughts, I wrote an article on Substack, so I'll drop a link below. But yeah, I thought the Silver Squeeze was pretty well coordinated. I loved all the memes. Mm-hmm. I wasn't really around for the first one, so I don't know. What do you think? How it compared to that?
That's good because this one's much more organic, much more real. The first one was organic, then it got taken over, it got co-opted within a week or two, and the actor that took it over and turned out to be a real bad apple. And so there's a lot of bad taste in people's mouths. And so when the Silver Squeeze 2.0 came around, people were spitting on it, and that's great. I love it when people spit on things that I buy because I know it's cheap and it's very So people were all, saying it was garbage, and it's not true. Like I went to the coin shop that day, because that's just one way you show that you're into it with everybody else. You buy and you show online what you did, and everyone celebrates. And when I went to the coin shop, this random guy behind me, he's like 40s, my age roughly, and I look behind, and he's got this like gleam in his eye, and he's smiling. I'm like, hey man, he's like, hey, you here for the Silver Squeeze? I'm like, yeah. I'm like, how did you hear about it? He's like, it's been everywhere. I'm like, this is hilarious. Like, I mean, it just shows you the effect. We just kind of ragtag that thing in the last month or so. I mean, we weren't even in the chat for a month, and then we kind of pulled that off. So it's amazing the effect that we have. Yeah, that's cool, man. It's interesting to hear about the atmosphere of the coin shop. I didn't expect you to bump into somebody who was actually there for the squeeze. Thought it was kind of more online sort of thing. No, it happens both ways. It happens a lot on the brick and mortar retail front in the United States. Virtually every major metropolitan has brick and mortar coin and bullion shops. So a lot of people just they want to have it right away. They don't want the delays. Sometimes they're worried about having any type of paper trail, even digital. And so they'd rather just come put cash on the desk and just walk away with their bullion and have, very little paperwork at all. Yeah. Now let's move into the gold to silver ratio. So we've seen that recently it's continued to soar. I checked it yesterday. It was around 100 to 1. Let's see. Do you foresee a violent correction once the ratio peaks? And how are you personally positioning for that? So every time, and I've looked, if you can pull up like longer term charts on this. I use TradingView a lot of times. It's free. Mm-hmm. And you can pull up charts that go back 100 years, gold silver ratio. And, virtually every time it spiked up beyond, really high levels. Like in 1991, it got up to 106. Our high here recently was 105. And COVID, it got to like 120. Like 126, yeah. And then the GSR in October of 2008, when banks were imploding, got to like 88. And in each and every one of those cycles, there's 4 of them, you basically had within a month, the following month, it collapsed down. And then another month, it goes down a little further and a little further. And so virtually every one of them within 4 to 5, 6 months, you have a massive falling of the GSR. And so my expectation, if past is precedent, if that's true, in the last, how many times? 3 times in the last 35 years that's occurred. It's quite likely that will occur again this year. So my expectation is that we've seen the high, unless the only caveat I give is that banks just start imploding like everywhere, and we have just this huge derivative explosion in the world, and dominoes start falling. And I expect that at some point. I don't know when, but at that point, it's like you're gonna have to start doing your own price discovery, because the bullion market's going to completely dislocate from whatever they say spot and futures are. And so price discovery at that point is going to become you trying to market make yourself, out there in the wild. So right now, I think that high's in, and I think we can cut down. We can get back in the 70s for, if we get a real run in silver this year, my expectation.
Yeah, and I saw, I'm going to put this infographic up, but I saw that the historic ratio during bimetallic standards was 15 to 1. Mm-hmm. It looks like we have a lot of support around 60 and also around 30. If I remember the levels correctly. Do you have a target for any of those levels, like a first good target to look for, possibly?
60s has been the average pretty much throughout the full fiat currency era. And so 60s is kind of the norm. And here we are, well above 60. And the hundreds is literally like a breath of, it's like that in terms of time. How much time has the spot gold silver ratio been over 100 in history? It's like literally like a snap. It's not long. So these are brief moments, and they don't last, and so, 60s is probably the range that it goes toward when it starts bulling. But when you start seeing it go toward 50 and 40s and back to 30s, well, now you're getting back to the 2011 low, which dipped briefly below 30 on the intraday level, but it was in the low 30s. And again, I worked and lived and invested through the 2011 silver that ran to 50, and this is much bigger than that. I mean, the 2011 version was, the social media situation wasn't as large as it is now. The speed in terms of communication, in terms of getting in people's lizard brains, it wasn't even close to what it is now. So now you have the ability to have that just rapidly accumulate and move quicker. And what you end up getting is just a huge FOMO of people wanting to get into silver because they've seen how well gold is done, and they're going to want to get to draft behind gold. And they'll learn the story about how silver can do virtually the same things in a bull market for you that gold does. And so, my expectation is that low 30s is inevitable, and then beyond the low 30s is probable. In terms of where this mania goes, and for it to go into the teens again, is something highly possible. I think if you look at if you drag it out, let me see what 1980 got down to during that. That was a Western-led bullion bull market, and it got down to just below 15.
Okay.
On a brief basis, but it stayed in for months. It stayed below 30, 35. I mean, it got down. I'm sorry. Yeah, for months. Let me see here. 1, 2, 3. Yeah, so for 4 or 5 months, it stayed well below in the 20s and teens. So it wasn't just like a one-day thing. It went down there and it stayed down there for a good while. And my expectation is it would be similar, for this to happen.
And so I read that they mine silver at a 1-to-8 ratio to gold.
Right.
Do you think that I've seen this guy Chris Duane. He talks about how it could go to 1-to-1. I guess anything's possible, but
right. I don't necessarily stake my reputation or name on saying such things, because I think it's, if it happens, great. But I mean, if it doesn't, it's not a big deal. I'm not too greedy in the terms of I kind of see the trade where it's obvious, and I'm not always going to be so heavily allocated to silver. When that starts to happen, silver starts to get not only back to fair value, but to beyond fair value, where it becomes overvalued. That's when you got to take a lot of gains off the table and move it elsewhere. At that time, there'll be other markets. The stock market will probably be in a massive bear market. Most people will be selling and saying stocks are trash, and that's generally when you want to own and start buying stocks, because in any cyclical market, it's just the bear markets always produce the ultimate undervaluations, and that's where you want to buy into undervaluations and you want to sell overvaluations. Yeah,
that sounds like a perfect strategy. And I would say too, personally, from my technical analysis, my first target would probably be around 1 to 30 or 1 to 40, probably, just to be safe. But it's something
that's smart. I mean, the low 30s is a smart level. I still think it goes beyond that, but there'll be a lot of doubt at that time whether or not it does. There'll be a lot of times in the bull market where you're going to think, well, that might be the top, and everyone's going to be saying that's the top, and it's not the top. It's still not the top, because it still has to blow off and do something spectacular that blows 2011 away.
Exactly.
So, you got to go back and use those as your gauges to understand where we are.
Let's go to hidden leverage in the system. All right, so we know roughly that we have around 409 paper claims for every 1 ounce of physical silver. What does this extreme leverage say about the true health and honesty of our financial markets, and how might this all unravel?
So, derivative leverage is basically the way that we've suppressed silver and gold prices and created a system where the dollar is considered gold. And now it's starting, the scales are falling from our eyes. We're starting to realize that the fiat US dollar in its current form is not even close to gold. It's devaluing our eyes. A gram of gold now costs more than $100 bill. I mean, to go out and buy a retail gram of gold is like $120, $125. And, so think about that. I mean, that fits on the very end of my finger, like a very tiny piece of gold, and you pull out $100 bill and this is worth more. I mean, we've lost like 90% of our dollar purchasing power in gold since the century started. And, here we are at 2025. What do you think the trend is, Jack? You think this trend is going backwards? No, the trend is going to go forwards. It's going to keep going this way. And so you can sit here and poke around and think, well, I'll buy it when, tell me when to buy it. Now's the time to buy it. You need to have a position now, not later if you don't have anything. And yeah, of course, don't do it all at once, average into it and look for gold to go back and test its 200-day moving average at some point. It always does in bull markets. But the concept is you're dealing with a system that's unraveling. And in the unraveling, gold is going to start showing the fact that it's worth way more than has ever been thought of because it's been covered by derivatives and fake price discovery signals for decades. All right. And so now we're looking at, gold is well over 100 paper claims to 1 ounce of gold. And this is not just me and you and some weird corner in the internet saying this. This is Indian Central Bank in 2013 did a study, and they said at the time it was like 92 and a half paper ounces leverage to the 1 physical ounce of gold in the world. And that was in 2013, and it's gotten worse in terms of the leverage involved to keep this bullion price suppressed, keep the system going so that people have this illusion that these paper currencies are actually worth what we really think they are. I mean, intrinsically, they are only worth what the promise files are worth and what we can actually pay upon. And we have record debts. Western world is just covered with unfunded liabilities that I don't know how we're going to pay. You know how we historically pay that? We either default on it, say, look, sorry, it's over. We got to reset the tables. That's probably not going to happen. Generally, what they do is they debase the crap out of the currency. And that's the route to take. So
James, sorry, let me cut in real quick. So you mentioned India. Everyone's been joking in the silver squeeze community about going back and looking at how many times people have said "buckle up,"
right?
And why is this time different, right? Do you think there is something different this time though? Because you see countries like India and China and other countries throughout the world accumulating precious metals also. I mean, back when the Hunt brothers were, trying to corner the market, I think, I don't know, maybe you can speak to that, but were countries back then also accumulating?
No, that's why I always refer to the 1980 bull as a Western-led bullion bull market, because it was literally the Western world calling to account the prolific amount of currency that was out in the system, and gold had been far too suppressed for far too long. The London gold pool had gold rigged at 35 for decades. And that basically fell apart because all these countries were coming to the United States saying, look, we don't want your dollars, we want the gold. And the United States at a certain point said, look, we got to stop this. And so in 1971, they cut the ties. They basically defaulted on the agreement that they made, the Bretton Woods agreement, right? So from 1945 to 1971, that's how long it took. And gold went berserk. I mean, gold went from 35 and then it went to 200 by like the mid 70s. And then they basically had to create this gold futures contract on the COMEX. And there's literal cables out there that were published by WikiLeaks that state, that London and the U.S. Treasury agents had a meeting in London, and London dealers said, if you create a futures market, you can inject so much volatility with outsized leverage, with outsized paper to underlying physical, that we can actually move the price around and dissuade new U.S. market entrants, because 1975 was when gold got re-legalized. Well, we can dissuade them by shaking the crap out of the price. So yeah, you know what happened? 1975, gold COMEX starts, paper trading. The price went from $200 in about a year and a half to $100. Right. So that's going to dissuade a lot of people, grandma and grandpa, because they think, well, it's obviously not performing. So why would I buy gold? Right. Yeah. So what happens in late summer 76, it gets to 100 and then it turns around, and every suppression inevitably has a blowback in its face. And what happened is it eightfolded right in their face from like late summer 76 to January 1980. It went from 100 to 850 as the top. And the only reason that was the top is because they literally capped the price in silver. And all, gold and silver simultaneously, when they went in and said, oh, no more longs on silver. And the reason underlying that is like, it's in congressional testimony. 9 out of the 23 board members of the CME were actually short on the silver side at that point. And so they voted to repeal anyone further going long in silver, because they were going to go bankrupt, these guys. Like, they were going to get their heads handed to them, because if you're caught short, there's no limit to how high it can go. And so silver and gold could have gone even worse. They could have gone even higher. So they had to come in and step in and stop the market. And so what ends up happening is you see palladium and platinum then go bullish for the next 2 months, because probably all the traders were like, well, we're just going to move into the other two precious metals. So those both mega spiked a couple months later.
Awesome. Yeah, that's. I think you've mentioned before the benefits of holding physical over paper, because they can halt trading. There's force majeure. Even David Bateman talked about it in his tweet manifesto. He talked about the great taking from David Webb, which everyone I think should watch. I'll put a link to that too in the description. But yeah, I wanted also to move on to SPVs. and see what you thought about that. So entities like Exchange Stabilization Fund and offshore special purpose vehicles, they operate in the deep shadows. What role do they play in propping up the dollar system and rigging markets behind the scenes?
So the Exchange Stabilization Fund was started from that original sin in the 1933 nationalization of gold. And it was started in 1934, the Gold Clause Act. That's the printing where they basically said in a decree in a law, like, hey, we'll rig any market anywhere if it's for the dollar. You know, we just flat out caveat, you know, be careful out there because we'll just come in and change any market if it's for our privy. So that's what the ESF is all about. It still operates today. That's why you have the New York Fed with tens of thousands of people working at the New York Fed, and they also have a co-located office that they built right next to the Chicago servers. So they're in the commodity markets, they're in the stock markets, they're in the currency markets. They're always everywhere in terms of in the markets. And they probably, you know, I'm not sure exactly how they're doing it, but they're definitely in there because this is a fading empire, and a fading empire wants to have control over the levers of price discovery, or at least a lot of persuasion on what's happening in terms of price discovery. That just makes common sense. If you were a fading empire or if you were a mega empire, you'd want to have that too, because it just helps you to manage your empire.
Well, I heard a lot of them were in the Cayman Islands and Belgium.
Right. So that's one thing. That's one thing that they're doing in terms of financing the treasuries, whether it be the bonds or the bills. I would imagine they have dozens and dozens of plates spinning in terms of where they're doing it, how they're doing it, and you know, it's a question of, you know, the optics. Like, how can they get away with it? Can they hide it? So they use a lot of special purpose vehicles. That SPVs were used during the COVID bailout system. Basically, they create these SPVs offshore, and they can do all types of things with these special purpose vehicles. They're just little entities where they can use them as essentially little hedge funds offshore, and they can move markets or buy distressed stuff at full price, you know, and bail out everybody and give, you know, hedge funds these massive loans where they don't even have to pay it back, just free handouts of money. The entire 2020 thing was just, I mean, other than checks for people who were struggling, and that's totally understandable. I mean, that was a pittance what they got. And compared to like what the hedge fund community and all these elite people, they were just robbing the treasury just flat out in broad daylight. And there's really been no one's gotten in trouble for that. There's been no disgracing of people in public. Truly, I mean, it was really, really ugly in terms of what happened there.
Yeah, so I guess essentially you would say these guys are just kind of like duct taping up the system, sort of.
As well as they're robbing the treasury at the same time. They're looting the treasury broad daylight, and that's the truth of the matter. I mean, we wouldn't have all these fiat financialized billionaires making money off just gobs of money for not producing a damn thing, just thrifting system. You know, we wouldn't have this mega elite of wealthy people, especially through the fiat financialized world. It wasn't for the leverage involved. It wasn't for all the ridiculous derivatives involved. And you know, they go in those markets and they make ridiculous amounts of money because the markets are so perverse. They're so ridiculous in terms of what we've created. We created a zombie price discovery system, and that's what we're dealing with.
Is Trump a savior for the U.S. economy or a strategic wrecking ball? What do you make of his economic policies, especially around trade, tariffs, and the Panama Canal?
I think it's TBD to see, you know, what Trump's ultimate legacy will be here. He'll either, you know, go down as a man of folly, or he'll go down as somebody who actually did the right things and the hard things. You know, I can't say. The verdict's still, you know, the jury's still out on it.
Yeah.
In terms of his tact and the way he does it, you know, his negotiation styles, it's rough, it's tough, it's difficult, and I think foreigners resent it. You know, if you talk to most foreigners, they resent it, and I don't think that goes away. That resentment, I think we get blowback from that resentment eventually.
Yeah.
In terms of his economic policies around trade and tariffs, TBD still. I mean, just him standing in front of the world with his little tabernacle of tariffs and like the visuals of that was just crazy. Absolutely insane, you know. And then the Panama Canal thing's crazy because I spent last 5 years living in Panama, so I got to know that country. The 1989 invasion of Panama was just a completely embarrassing debacle. We basically had, a dictator there that he was basically, I think it was CIA involved. There was huge amounts of cocaine running through that country, and he wasn't listening to his declarations. Like, we were telling him to do things, he wasn't listening anymore, and so George Bush made an example out of it. Yeah. And it was just disgusting, the fact that, you know, it was live television, 1989, you know, around the football bowl games, you get to watch live on TV as we're running through Panama, you know, creating chaos, and like 1,000 people died in that invasion. It was a joke.
It's horrible, man.
Yeah, and the Panama Canal is weird. The history of it. I mean, the French started it, they tried it, and didn't really work out for them too well, and they were underfunded, and people were dying from malaria, and so it just basically, they didn't get it done. And the United States was looking; they had always been looking for a way to either create a canal in Nicaragua or Panama. And you know, France had already started that, and they basically came to the idea that basically, well, we got this group in Panama, and we can fund it, and then we can also help them coup out of Grand Colombia. And so they had a coup in the early 1900s with Panama, creating their own state and getting out of Grand Colombia. And they built the canal, and at a lot of cost of lives. The amount of United States citizens that died in it was like 305 or whatever, but the amount of brown people that died in it was like 30,000, and they were from all over. They were all over. They weren't just Panamanian locals. They were brought in from other places to do that really difficult work of dredging out. I mean, the whole Lake of Gatun is basically a man-made lake. I mean, that was not a lake before that. They flooded that entire zone. And then you also had to build up these massive trenches going uphill and then back downhill and create the lock systems. So, I mean, it's a lot of work. It's obviously a very important part of infrastructure for our side of the world. With the Monroe Doctrine, we believe that that's in our sphere of influence. Therefore, it's ours. It's our key infrastructure. So China has no business being there. Great, that's fine. The problem is that we've been going into Panama and doing wild things that you probably don't even know. Like in 1941, they created their own currency, right? They had a dollar, the Panamanian dollar. They were trying to create their own currency and have a little bit of sovereignty and authority over what's happening in their economy. They created this currency in 1941. It was literally printed on Hamilton currency print. It looks like a U.S. dollar, but it's Panamanian Bolivar.
Oh, that's awesome. 7
days later, after this was done, the United States had a coup. This president just got launched. 7 days later, it's like, no, dude, we run this place. You're going to use our U.S. dollar, and that's just the way it is, Jack. And so, I mean, think about that in terms of, you're a Panamanian national, and you look up at Gringolandia north, and how would you feel, right?
Yeah,
would you not be interested to see the new boss and see whether or not it's the same as the old boss? Therefore, you'd flirt with China a lot, I would imagine.
Yeah, 100%, man.
Right.
I feel like that's a common theme throughout the last century. It was just reminding me of Gaddafi.
Sure. Yeah. Gaddafi's the same story. They were getting together and they were going to create some type of block in Africa, to try and use the dinar and gold and silver. I mean, it's part of their religion in terms of having sound money and not usury.
Yeah.
And, no, that guy gets thrown out. And I mean, the PNAC documents, all the things that happened in the early 2000s, where Wesley Clark was talking about going into the Pentagon and they saying, oh, we're going to knock out the old Russian client regimes. He goes through a list. The only one they haven't done yet now is Iran, and they're trying right now to do that eventually, it seems.
Yeah.
So it's disheartening. All the chaos in the Middle East, all these beautiful cities just got blown up because, we have this agenda where we got to take out the old Soviet regimes and we got to use our military for something. So let's go bomb these places.
Yeah, and I think it all ties back to dollar hegemony too, which people don't realize how important that is. Like, all this war stems directly from maintaining the monetary system.
Maintaining the control. That's what the dollar does. The most important thing is not even, it's the grift that the corporations go there and they make a lot of proceeds and a lot of money by basically creating monopolies and stealing all the assets at cheap values. But it's really the ultimate hierarchy of this is having control as an empire and having, the ability to dictate terms and tell people how they're going to live. And that works for a while until it doesn't. Just go read a history book. Eventually it fades away, and we're headed that way.
You're getting close. One more idea I had about the tariffs. Just was thinking, do you think that this is some sort of plan from the Trump administration to sort of force the Fed's hand by spooking the markets and forcing them to cut rates and do more QE?
Yeah, ultimately they want to have interest rates pushed down. They want to get it down because the higher the interest rates are, the more expensive our debt gets, and the wider the deficits grow. We're on pace. We're 20% beyond, 22% beyond where we were last year, halfway through the year in terms of the government, how much deficit has grown. So we're still growing the deficit, even at the time where all these Utopian D.O.G.E people are running around thinking that it's
This is the chainsaw for bureaucracy.
Get your eyes and read the math. You just pull the sheets out. $100 million means nothing in the scope of trillions. It means nothing.
Yeah.
So you might get on social media and cheer the fact that he's going to stop them all. It's like, you are delusional. Like, use your brain and do some arithmetic. Like the actual deficit's going to 2 trillion plus, and the only way to get it down is really to pin down interest rates. And so yes, I think you're probably right. They want to scare the Fed into cutting rates and getting it down. Ultimately, we're looking at a situation where the rates are going to be here and inflation will always be up here. They always have to pin the true what you're going to get in interest will never serve you in terms of what they're going to do to the currency. They're going to deflate. They're going to inflate away the currency, and you never get in terms of real value back. Interest rate wise, ultimately we're headed to a place where now they're telling people, countries in our sphere of influence, you got to buy this 100 years of debt. So sorry, that's just the way it is. I'm sure they won't resent that. And then ultimately they're going to turn. And they're going to say, "Hey, U.S. citizen, guess what you got to do? Now every paycheck, X percent goes into funding the state. You're going to have to be buying these AAA rated bonds or whatever. There'll be triple C by that time. But that's coming as well. You as a U.S. citizen, they're going to turn to you and make you do it, and they'll probably make the banking system do it as well. But by that time, the banking system will be further consolidated, I would imagine. But that's ultimately, I think, where we're heading.
Yeah, agreed. 100%, man. So we've covered the present. Now I want to talk about the future. The capital rotation. Do you think we're at the early stages of a capital rotation? And if so, what sectors or asset classes do you think will perform best in the new economic cycle?
All right, I think we are. I mean, if you look at like one of the key charts I look at is the S&P divided by S&P 500 divided by gold on like a long-term basis. And the way it's starting to look is it's starting to look like a rollover, like it looked during the Nifty 1960s bubble. The fact that it's at like 1.68 right now, 1.6 ounces or 1.7 ounces to buy one nominal share of the S&P 500, it's a lot. I think over long term, I mean, that's higher than it was at the peak in 1929. This is still levels that were, I mean, the fact that 1929, we're above that level. And on the silver side of that chart, silver S&P 500 divided by silver, it's stupid. Like it's really stupid how high we are. So gold generally leads, and it's leading on that chart. It's spiking downward. And, you might get a bounce pretty soon, but like ultimately, it looks like it's going to roll over at some point. And we're going back down to the normal average generally when you look at a long-term basis is almost 1-to-1. Like 1 ounce of gold should be able to buy you the nominal S&P 500. But it swings wildly above. Like I think it got to 5-to-1, 5 ounces to buy one share in like the original stock bubble in the 2000s. That was like the all-time high. But this latest dead cat bounce stock bubble that we've had in terms of gold, it got pretty high. I mean, I don't have the chart up, but I think it got to like 2.5. It got halfway up. But for it to roll not just back to 1-to-1, but for it to roll where a half ounce of gold will get you the S&P 500 is most likely probable. But look back to the 2011 low where it went during August 2011 and imagine where it's going to go beyond that, because I think that's ultimately where we're headed. 2011 is just a kind of conservative medium range target. I think on the longer term, you got to look back toward the 1980s low to get an idea of this mania could go in terms of dividing the S&P 500 by gold. Silver will outperform. I think ultimately it'll just take a little longer and it'll be much more wild and volatile. So people, kind of have to buckle up, right? And
I was waiting for it.
And the other thing is you're asking about like the capital rotation. I mean, commodities are super cheap across the board. I think on a historic basis. So you're just going to see another commodity super cycle. I think coming 2030s, where commodities are going to start to boom, and precious metals in that type of scenario tend to outperform virtually everything for multiple years running. So you could imagine to see gold really, it's been doing great, and gold will continue to do great, but silver will do even greater. That's kind of the expectation I have at certain points, and that can go on for years after years after years in terms of commodity super cycles where the double precious metals and even platinum and palladium can do really well as well.
Sounds good. Yeah, I would agree too. So I kind of want to think about this as like sort of like a math problem, right? So I think we have one side of the equation, and I'm going to explain it now. So in 1977, the Federal Reserve's dual mandate was set. It was to maintain price stability and promote maximum employment. But over time, many argue that its policies have disproportionately benefited asset holders, particularly the top 1%. If we operate from this equation, how do they protect the wealth of those on top as we move into the next iteration of our monetary system?
All right. So, I mean, in terms of the Federal Reserve, there's a lot of people out there who believe Trump ultimately wants to close the Federal Reserve. That's first and foremost, because he knows that this entire machine is set up for the elite to benefit. It's for capital to benefit over labor. And it's gotten out of hand. I mean, if you look at societies, such a disparity of wealth, we're looking like Brazil. I mean, we don't have gangs yet, armed gangs, but that's where we're going. And you're going to have kids get kidnapped at school if you keep this kind of crap up. So if you want to have like a society that's open, that has trust, that has an actual culture, that fabric that's not disintegrating at the edges, you need to have the disparity of wealth come back into equilibrium because it's gotten out of control. And so, I mean, if you look at the disparity of wealth pretty much since the 1971 cutting of the ties of gold, I mean, capital doesn't want labor to own bullion. They want labor to be dumb. They want you to be real stupid, and they want you to work your butt off for nothing. They want to get as much for them and as little for you, as long as you just keep working and shut up. And so that's the sense. You got to get educated. You got to get financially literate. You need to understand for you and your progeny what's going on here, what the game is, and how to protect yourself. And bullion is like one of the key assets that you need to have as your foundation of wealth at all times. If you live under a full fiat currency system, you always have to maintain some position in bullion because the system is there to take advantage of you. Whatever they pay you, they're going to debase that as time goes along.
And James, you wrote a book about this, right? If I'm not mistaken, you guys can find James your books on SD Bullion, right?
Yeah. This is I think we wrote it 2017. I went in there and sat down for 4 or 5 weeks straight and just wrote this thing. It's probably like 200 pages. It might not be up to date in terms of charts and graphs, but I think there's still a lot of evergreen content in it. So if you just Google SD Bullion Guide, gold, silver, you'll find it. a page where you can get it. It's like a free email. It'll come to you, and you can read it. Also,
Awesome, man. I'm gonna get a copy.
Yeah. Also on the website, if you go under the resources page, there is under the resources on the far hand right, there's investing guide drop down. Just click that, and that page is where you can get it as well. And there's also you scroll down. There's also little articles all throughout it, so you can just open up new windows and kind of scan that way as well.
Awesome, man.
The content that we made. This is in late 2017, so I probably have to do an update at some point. And I've been working on one. It's always a heavy lift, and it's like sometimes you get a lot of momentum, and then you pause, and the momentum's off. So I got to get back in there and finish it.
Sounds good, man. Well, it sounds like an interesting book. I'm definitely going to pick up a copy of it. And I'm just going to take a second and plug my new book as well. I just wrote a book on the Ichimoku theories and trading psychology and how to find the trading style that fits your personality type. So I'll put a link to that too for all the books below.
Is it a Japanese trader? Is that the guy who used the yearly candles a lot? He used candle charts?
Yeah. So price. So the guy who discovered price action and the Japanese candlestick, that's Monisi Hama. Mm-hmm. And he was a rice futures trader back in 17th century or 1700s. He discovered like the Head and Shoulders a century before we discovered it in the West. But I have all the history of that in the book, and also the theories on Ichimoku, which is a Japanese technical analysis system. I just finished it earlier this year.
Cool.
So I know what you mean about getting the momentum for writing and finishing up the books and stuff. Sometimes you need that extra push.
Yeah.
Okay, so you think Trump will end the Fed?
I mean, I don't necessarily think that, but there are people out there
who think he will.
Yeah, the MAGA Hopium crowd, I think, ultimately have the Fed on their target list, and they think that Daddy Trump is going to take care of that. I don't.
I think, this is what I was going to say. I think that if he does end the Fed, it will get replaced with something worse.
Something far worse.
Yeah, because if you just read a history book, there's never been a government that seeks less power, right? Right. When you reach this point.
Ultimately, for an empire, you have to go to collapse. That's generally how it goes.
Yeah.
We're not close to collapse levels yet. So that ultimately is generally how things work in the swinging of pendulums. You have to get all the way to the edge where it's collapsed.
Oh, I want to talk about that. So you posted something about Ray Dalio the other day.
A classic breakdown of the major monetary, political, and geopolitical orders. This sort of breakdown occurs only about once in a lifetime, but they have happened many times in history when similar unsustainable conditions were in place. Joining us right now, first on CNBC, is Bridgewater founder Ray Dalio, and we're thrilled to have you here on a morning when we're still trying to make sense of what all these tariffs mean, Ray, and frankly, how all of this plays out. So to the extent that you can help us with the history, or at least a history lesson, if you think there are parallels, how does this play out?
I think that we don't understand how the cycle goes because it comes along about once in a lifetime. But there are orders, there are systems, and the systems break down for certain reasons, and it creates cycles. For example, there's a monetary system, and then there's a debt cycle. And so as a result, we now have one man's debts, another man's assets. And when you build these up and you get to a point where you can't sustain that, you have a debt issue. We have a debt issue. We can get into that. But there's a monetary cycle. There's a internal political order cycle that takes us from one political order to another political order, in which there's then classically great turbulence between the left and the right. And because of disorder, particularly in democracies, there's a lot of fighting because there needs to be cooperation, compromise, and so on. And we're in the process of changing that order. In addition, we have the international world order. International world order began in 1945. There's a war. You win a war. The dominant powers get to set the rules. That was a series of multilateralism, things like the United Nations World Trade Organization, World This and World That. And that multilateralism is then breaking down for unilateralism.
I guess we know that long-term U.S. Treasuries are no longer outpacing inflation. And I think that's why we're seeing such a strong move into gold by central banks. Do you think the bond market is broken now? What are your thoughts on that?
So bonds went through a secular bull market that lasted for 40 years. Okay. After a 40-year bond bull market, do you not expect that there might be a 20-year bear market that follows? I mean, that's just common sense. I think 2020 was the beginning of the bond secular bear market. When we look back in time, realize that we're going into, the biggest asset class in the world is about to eat it, right? And so what happens? You have central banks front running it. They see that writing on the wall. They also see the fact that if they have their own gold on shore, they can't be frozen. They can't be, just arbitrarily put into a corner. And they basically will have some sovereignty if they have a lot of gold reserves. So the bonds, the bullion over bond trade is just beginning. I think, we've seen record size of buying in gold, but that's not stopping, I don't think. I think we're moving back to a world where the governments, their central banks, their sovereign wealth will be at least comprised of 30% of gold bullion and then 70% of other things, perhaps. But it probably will get even higher because the price of gold will just keep going higher. And I don't think at that point central banks are going to be like, we're going to sell now because this is the top. No, I think I think they know how ruined the system is because they were in charge for so long, and they know how dislocated it really is. So I think that gold is the big trade over bonds, and the stock market will see that as time goes on. But they're going to do what they can in the stock market with inflation. They're going to try and prop it up nominally. But the only way to cut through that is just simply divided by gold or simply divided by silver over a long duration, over a long 100-year chart. And you can see the roller coaster moves, and roller coasters generally, when they start going like this, they generally don't go back up. They generally go, see you later, I'm going down. And so I think that's heading, over a 5-10 year span. It's not happening tomorrow, but I'm saying over the next 5-10 years, you're going to see stock market melt to go.
Melt up, or what do you think?
Melt down. Gold is
melt down.
Really melted down. Gold's going to say, now it costs me 1.7 to get a share of you. I'll talk to you when it's 0.7. I'll talk to you when it's 0.5. I'll buy you a third of this price in 5 to 10 years. So the people who own bullion should gain in terms of purchasing power in the U.S. stock market.
Do you think that there is a possible scenario where, let's say in June, we get an emergency rate cut? I think the last time I saw the odds were it was 70% chance or something, or 60, something like that. I'll have to put that I'll put it in text. But if they do more QE, do you see a scenario where perhaps stocks are making new nominal highs, but gold and silver and commodities are also starting to surge? So you're getting this capital rotation, and you have the top 1% just pumping prices on stocks and whatever, and then rotating that as it's all going up together.
Yeah.
Do you think that could happen?
I don't know if it happens this year, but it definitely, you can see a situation coming years where you have a nominal S&P 500 record nominal highs. But in terms of gold, it's down because gold is going to be outperforming it for a long time coming. And so, yes, that's what I think they'll do in order to keep people pinned in the stock market and basically caught up in the illusion that the S&P 500 is doing fine. And that's what they're going to have to do. You can't have nominally cut in half and stay down there. That's not good. That's going to create holy hell, and it'll be very difficult to contain that, especially with passive investing flows. I mean, the stuff can just fall out of the sky if you're not careful. So you basically need to do what you can to prop it up nominally. But again, just divide it by gold, and you're going to get a sense of what the truth is. Take the dollar out of the equation and use gold as your proxy. Gold is the numerator. It's the one that people have to remember. Gold is the all-time numerator. It's not this stupid dollar thing. What we're coming through is a white brainwashing in the sense that the dollar is as good as gold. It's not. It's trash, and it's going up in flames. At least slowly. I'm not saying tomorrow, but it's happening before our eyes, and you have to snap out of it.
Yeah, and I like to think that the only reason the fiat dollar has any value is because it's tethered back to a system that actually had value. So
we have a system with we have violence and we have debt. Those two things kind of hand in hand. We have a really good brand. It's probably our greatest export of all time. The fact that we were able to just send them all over the world, and you can still go around the world and use them in a lot of places. But you can't do that with the Mexican peso, Jack. You can't do that with the Canadian dollar. I mean, the dollar is amazing how hard people work for. In Panama, $25 a day, how hard you get someone to work, and that's a middle class lifestyle for someone. $25 in a day, they can live pretty good. I mean, that's amazing. How far it's gone and how much power it is. That's slowly proceeding before our eyes. You have to wake up to the fact that that's not going to last. It's an illusion. It's something that it's been a persistent illusion, but it's starting to fade away and dissipate.
Yeah, and I think it's accelerating, if I have to be honest. Let's just get some closing remarks. One simple tip, James. How has your mentality or strategy developed over time with investing in precious metals and miners? What's a simple rule of thumb for anyone looking to invest in precious metals for the first time?
So a lot of times I'll use backtested data for bullion because I think this is a time to be concerned about a return of your capital, not so much a return on your capital. Bullion in a destruction phase like we're in right now is what you should own mainly. You shouldn't get out too far on the risk curve if you can do stay with things that are sound and that do perform in these environments. And bullion tends to do really well with very limited downside, especially if you own it outright or you have it in secure logistics like Brinks or for instance a Loomis in a direct account with no middleman. That's the way to go. Own it outright directly in your name, no middleman. So yeah, when you look at like the back-tested data from 1968 when the London gold bull failed to now in 2025, and you compare the S&P 500, or the bills and bonds of the U.S. versus the S&P 500 versus gold or any other bullion mix allocation, the 1968 to 2025 data states that the best risk reward ratio is owning gold bullion to 27 to 30%. In terms of your liquid net worth. Your liquid net worth, you want to have almost a third of it in bullion. Now, gold bullion has performed the best over the last 57 odd years or whatever it is to study. But, that doesn't mean that in the small time frames that silver doesn't outperform. So it's a question of what is your risk profile? How old are you? What are the reasons you're buying it? If you're first and foremost buying it because you don't want to lose capital, you definitely need to own gold because it's not as volatile. It's not as scary. If you're someone who's younger and you have a longer time frame and you understand that the GSR at 100 is Looney Tunes Clown World and it's going to go lower, you definitely then need to buy some silver allocation as well because it tends to outperform gold over 2, 3, 4 year time spans where it will really outperform gold. And so a mix of those. Even platinum is something that I'm interested in. I own some platinum as well, and I think long term it has good value. Being right now a third the price of gold, there's been times where it's been 12 times the size of gold in terms of price. I mean, when the 68 London gold bull failed, it was 35 gold and like 170 some for platinum. So like, platinum was freely trading and that's why it was so high at the time. But since that time, it's swung the other way. And so you've had a performance of gold over platinum since then of like 30 times almost. But that'll swing back. Once gold peaks, you tend to see platinum then move. It was just kind of in 1980, that's what happened. And I expect something similar. Platinum is just a freak metal. I think we still don't completely understand all the applications we're going to need it for. If we ever want to get interplanetary, if we really want to get off this rock, you got to need a lot of platinum, and platinum's in short order. I mean, I've done the research. It's not just like a newsletter clown show, like where they go out and say all the platinum in the world would fit in a U.S. garage.
Yeah, I've seen that.
It's actually true. Like I've done the research, I've done the work, and there's just not that much platinum. Like even Bateman was bragging on in the chat that he got a lot of platinum recently.
Nice.
He pulled it off the NYMEX, and he told us the numbers, and I went and looked, and I'm like, okay, well, let's find out what that is in cube size. And so he got basically a platinum cube in terms of volume. It would be 9.5 inches by 9.5 inches, right?
Wow.
Okay. Yeah. So like, how much would that weigh? It's really, really heavy. Like just off the top of my head, like a 6-inch cube of platinum literally weighs like as much as I do. It's like 180, 170 pounds. Like a 6-inch. Imagine that. Like, this is how heavy that is. So it's a really freakish metal. And I think we haven't discovered all the applications that we're going to need it for. And so I bet on platinum in the sense of our future, figuring out, ways that we're going to need it. And it's going to become more valued. It's going to become higher valued, and it'll get back to 1-to-1 with gold in time, I think, in my lifetime. I mean, I'm 45. I think by the time I'm 60, you'll see platinum rocketing, going back toward 1-to-1 with gold and probably beyond at some point.
Yeah. And I guess just to put it in a simple term, that platinum is more rare than gold and silver.
Yeah, but that doesn't mean much, right? A lot of things are more rare than gold or silver. The question is, what's the actual value, right? And in time period, right? So, like Picasso made 50,000 pieces. Some of them are not that good. They're just like a draft that he left in the corner of a room. And cool, that's a nice collectible, but it's not going to fetch much at the Sotheby's, right?
Yeah, true.
There's certain rarities that are going to catch more depending on the time frame and what they are, right? And platinum will have its day again. Right now, it's being spat upon, and people don't think it's worth much. Gold's 3 times its value. I mean, it'll probably go up to the point where gold's 5-6 times its value at some point with gold. I mean, gold's doing the restructuring. Gold is going to zoom, and then the other precious metals follow. And silver follows first, platinum probably a little later. That's my theory.
Do you think that platinum gets some momentum mainly because they're going to find new applications for it, or do you think it's just going to be a bleed out from the other precious metals bull market?
I think it's first and foremost a bleed out, and first and foremost a precious metal that everyone knows at one time was twice the price of gold in their lifetime. I mean, you go back to 2008, where we got over 2,000 an ounce in 2008 dollars, right? So it's going to be first and foremost like a precious small quantity store value. There's a lot of applications for jewelry and new tech applications. I mean, hydrogen cells and things like that. That's why China has to have it so much, because they're building out hydrogen infrastructure. So
okay.
I think first and foremost, it's a store of value. It's limited, that you can park capital in and hold it, and it'll be safe and precious. And then later on, I think those applications come along, because as we get more advanced society, we're going to start finding newer things that platinum can be used for, and that will create a new bull market in platinum at some point.
Okay, awesome. Yeah, that makes sense.
And the other question you asked about it was the miners. I mean, again, like I've dabbled in some miners, but like I always just pull out the 21st century chart of gold's bullion price versus the miners, and kind of understanding which is outperforming which. And this chart basically uses all the major gold indices throughout the world and gold bullion from 2000 to now 2025. And pretty much in 2007, what it looks like is that, in the beginning, first 7 years, miners were the place to be. But pretty much since 2007, what it looks like, there's been a hedge fund trade that's basically been long bullion or long COMEX gold or long derivative gold and short hedge funds. And so I think they have a pair trade on. And so it really artificially pushes down the miners. So you have an absolute underperformance generally from 2007 to now. So that's 18 years of trend that I don't think comes off for a while longer. Now, saying that, in between, there have been 3 or 4 times for like a year to a half year where miners have outperformed bullion. But generally, bullion has outperformed miners. And for the risk profile that miners offer compared to bullion, I just think bullion's a safer bet. We're in the construction phase. You want the return of your capital, not on your capital so much. And so if you're going to go into miners, I mean, use like the indices, use like GDX maybe. Yeah. When you like right now, GDX is starting to show some poppage. Like if you want to do a little swing trade in the GDX and try and make a little more juice that way, by all means, go ahead. The one thing about GDX is nice. It's one of those miners fail. It's not going to ruin your bet so much as if you were just co-located in one miner that went wrong. And I've had that happen.
You mentioned that you had some trouble in the past with what was it? Russia? It was a Russian miner,
like Polyus or something. One of the major ones. I forget the name of the thing, but like I parked, not like a ridiculous amount of capital into it, but I thought like, all right, well, look, this company is like a long-term miner bet that I'll make over the next 10, 15 years because they're going to unearth tons of gold in Siberia and Russia. So I think Russia is ultimately going to become the biggest miner of gold in the world. They'll pass China at some point, I believe, because there's just so many resources in Siberia that have yet to been pulled from the ground. And so this was my long-term bet on that. But then the Ukraine thing happens. I kind of froze like a deer in headlights too late. And then the U.S. Treasury came in and basically froze all these, accounts. So like, I mean, unsecured credit, I got nothing. Like the Treasury has my shares frozen, and it's like I don't know when, if ever, I'll get them back. And if I do get them back, what are they going to even be worth? I mean, the company may just say, "Sorry, those are worth nothing. They're worthless." So I don't know what will happen to them. But it just, when that happens, it's like a lesson that you don't want to repeat that same mistake again, and you also want to warn people from not making that mistake that you did. So
treat it like leverage. Treat it like something that it could go away, kind of like.
Go away. So only put in it where you're able to lose, right?
Yeah.
Like, so I was able to lose that Russian bet, and hey, my life's not ending and everything's fine. But like, if I was way too far deep into it, it would have really altered the course of my life in terms of my quality of life. And you just can't be some YOLO fool in a world where you're looking at if you have a gold price at $5,000-$6,000 an ounce, how many of these countries are going to say, "Hey, miner, what's going to happen now? You're going to sell us all your gold at this kind of price, and that's it. If you don't like it, we'll just nationalize it. We'll find new management. So that's going to start happening all over. So you got to be very, very smart and intelligent about how much of an allocation you're willing to risk in a place where it can go wrong real quick.
Absolutely, man. I think that's great advice. Yeah, exactly. Actually, to close, I just wanted to read part of the last part of Bateman's tweet. He says, "This is not a drill. Your grandkids someday will either muse or lament this financial decision you're now faced with. Don't fail them." And then he says, "Not financial advice, for educational purposes only."
In a litigious society, you gotta always say that. It's ridiculous. Yeah. But, you basically have to start any type of thing like, "Hey, I'm doing this for entertainment. I'll get entertained." Okay.
Yeah.
It's like we have to do those clauses. But yeah, he's got a good point. It's I think ultimately, if you're on the wrong side of this choice, you could really screw your progeny over, and so you have to be very careful about this and smart.
Absolutely, man. All right, James. Well, what's next on the horizon for you, and how can our listeners follow your journey?
So, I'm working with SD Bullion. So the best way for following my work is week to week on Fridays after trading. I generally publish a weekly bullion market update, and so I try and boil down the most important news items and data for the week. Or what I've seen, I basically aggregate it and try and boil it down to like 20-minute videos or 15, sometimes to 30 minutes, depends. But it's like a video that I create, out of whole cloth, essentially, with using data and information and interviews that are happening online. So it's basically a look in terms of what's happened in the market through a bullion stacker's eyes. And I try and I publish that every week on the SD Bullion channel, so it's free and people can go check that out. And as well, I'm on Twitter at James Henry and at the end of this month, we'll have another Silver Squeeze. So that'll be fun. That's coming up.
Oh, okay. Well, what day is that?
I believe it's the last trading day, which might be April 30th. But it's always going to be the last trading day of the month because of the fact that the market riggers always want to paint the tape lower. And so, but basically by waiting to the end of the day when they paint the tape lower and buying on that price point, you'll generally get yourself at a lower price than it ought to be because they're always trying to paint the tape lower.
Makes sense. Well, James, it's been an absolute pleasure. Thank you so much for joining me today, and look forward to speaking to you again sometime.
I appreciate you having me on.
Thanks, man.
It was fun, and we'll do it again some point.